Okay, you all had asked me about the federal laws you needed to know for this test, so let's do this review. Our first law is going to be TILA, or Truth in Lending. So, what is truth in lending? Truth in lending is the act that has to do with lenders being truthful, hence truth in lending. This means anytime a bank is going to loan somebody money, they have to be honest about what the true cost is going in. That means they have to disclose what the APR is within 3 business days of the loan. Of course, they have to disclose the APR. They need to disclose finance charges. They need to disclose the amount financed. They need to disclose the total payments. So how much are you paying each time you make a payment, and what's the total amount this is all going to come to? Now, I keep saying APR, and I think understanding that an APR versus an interest rate are two very different things. Well, not very different, but they are different. If you go to the bank and you want to borrow money, let's say to buy a house, then they could tell you, hey, our interest rate, what we're going to charge you per year to borrow this money might be 5%. Okay, that sounds good, 5% interest rate. However, what that doesn't tell you is what are all those other little fees that add up, like your points or origination fees, things like that. When you look at the true cost of doing business with the bank, that is expressed as the APR. The interest rate is just the interest, and the APR is going to be a little bit higher because we all know banks charge fees. So interest rate might be 5%. Maybe your APR is 5.25%. I don't think that's a really accurate number, but you get the point. Your APR is going to be higher, and that is why when you apply for a loan within 3 business days, they have to tell you, hey, this is what the true cost of doing business with us will be, that APR. And they'll do that on the LE, which we'll get to later. The LE is the loan estimate. Now, you'll often hear TILA mentioned as Regulation Z. Regulation Z, TILA, TIL, however you call it, it's basically the same thing. Regulation Z is just the arm that allows the government to really support the rules that TILA put forth. So when you think about the CFPB, or the Consumer Financial Protection Bureau, Regulation Z is part of the laws that helps make them effective. So it's the CFPB that monitors. It's a Consumer Protection Bureau. It's a Consumer Financial Protection Bureau. So Regulation Z is the arm that says, look, CFPB can do these things. Hey, the CFPB has the right to look at your advertising and say, you need to give the consumer more information. If you tell them you can own this house with only 2 payments, if there are 2 payments of $250,000, that needs to be included in the advertisement. So Regulation Z has to do with the advertising, the enforcing, and making sure that lenders are being honest and truthful about what it is they're charging the consumer. Now, TILA, unlike our next couple of laws, is going to apply to lots of different loans. Obviously, mortgages, most mortgages, 1 to 4 family residences, doesn't matter how much it is. Non-real estate loans, maybe you're getting a car. You ever see those car ads and there's all that fast talking at the end? They've got to tell you all those details because of TILA. Refinancing, consolidation loans. Before the test, remember, TILA does not apply to business, commercial, agricultural, loan assumptions. Every so often, they'll throw that little tidbit in, who does TILA not, or what does TILA not apply to? There you go. Now, related to TILA, having to do with monies, we've got RESPA, or the Real Estate Settlement Procedures Act. I will tell you, this one is about real estate settlements. So this would not apply to your car loan. This would not apply if you go to the bank and take out a personal loan. Everything I'm getting ready to say is just about real estate. Now, RESPA has some requirements real estate settlements. So if you're doing a closing for a house and somebody's borrowing money, these are the laws these are the rules that the banks have to follow. And it's not just banks, it's going to be real estate agents, attorneys. I mean, it affects a lot of us in the real estate industry. First, we have my acronym, which I know is a little silly. Young kids eat up boogers, glue, and dirt. Is it ridiculous? Yes. But will you remember it? Also, yes. So my job is done. Okay, young kids eat up boogers, glue, and dirt. First, we've got yield spread premiums have to be returned to the borrower. This just means if a mortgage banker is going to be making money, sometimes they're given extra money for getting you to take a higher interest rate or something like that, or they used to. The law came in and said, nope, you can't do that. Now you've got to make sure that those monies are returned to the borrower. It's a long story. Just have an idea that if you see yield spread premiums have to be returned to the borrower, that is about RESPA. Next, we have kickbacks. Kickbacks are prohibited. If there's only one thing you remember about RESPA, this needs to be it. Kickbacks are prohibited. And this law says, look, if you are giving monies for the referral of business, hey, you should totally use this person, and then that person kicks you back some money, that is going to be highly illegal. Go to jail, do not pass go, we'll see you in your orange jumpsuit, illegal. No kickbacks. If it is any type of settlement provider, that's the word I'm thinking of. If it's a settlement provider, so if you have an inspector or an attorney or an escrow agent that's like, hey, if you scoot some money over to me, I'll give you $50 for every client. Absolutely not. Absolutely not. That is prohibited. And it doesn't matter if it's money. If they give you a $50 gift card, if they give you tickets to a football game or a basketball game, anything like that, that is going to be prohibited. Anything having to do with a real estate settlement. That's the big one. If you learn nothing else, that's the one you need to know. Now, there's escrow account restrictions. That's what the E stands for, and young kids eat up boogers, glue, and dirt. So we know when you were looking at PITI, your pity payments, you had the taxes and insurance payments. They're saying, look, yes, the bank can ask you to put a couple of months or how many ever months they need into an escrow or reserve account for you. That's fine. But they can't ask you to put 26 months of escrow payments into that account. Like, that's a bit much. They're going to limit how much the bank can ask you to have in a reserve or impound account. Right? Also escrow accounts. So when we talk about PITI, how much T and I can go into that account is limited. The U is for uniform settlement statements. It doesn't matter if I'm looking at a settlement statement from Hawaii or from California or Montana, Michigan, New Hampshire, pick a state. If it is a loan with a bank that's federally regulated, so a mortgage basically, they need to use the same settlement statement. Back in the day, we used to call them a HUD-1, but thanks to TRID, which we'll get to in a moment, you're going to use what we call the closing disclosure, or the CD. We've always had to use the same settlement statement, but the fact that we use a CD is because of TRID. The fact that it has to be the same is because of RESPA. The B of the boogers is for a booklet. Lenders need to give borrowers this booklet called Know Before You Owe, which is giving the basics of lending. Hey, this is a loan amount. Here's an interest rate. Here's an APR. Here's a point. What's a discount point? What's a loan origination fee? The idea here, and this was written by the CFPB, is that any lender has the ability to give information to the borrower that borrower can trust. That borrower can know, hey, I'm not being lied to. I'm being told the truth. I know I've got some basic information so I can talk to this banker and be well educated. The G, the good faith estimate. The good faith estimate is similar to what we said in TRID, where 3 days after application, you have to be told the APR. Well, RESPA says 3 days after loan application, you have to give the borrower a good faith estimate. Keywords here being a good faith estimate. We don't know the exact final numbers, but in good faith, here's what we think your numbers will be. The GFE, or the good faith estimate, within 3 days of loan application. And the D, the DIRT, is for disclosure of loan servicing. If a bank is going to use another company to service the loan, collect the payments, make sure you're paying the right amounts and on time, etc., they have to disclose that to the borrower. Disclosure of loan servicing. So RESPA requires young kids eat up boogers, glue, and dirt. Hopefully you remember it. At the very least, you'll remember the picture, and that's good. Now, again, the biggest takeaway, no kickbacks. Some of you might have gotten into this business thinking, oh, I can do referral fees. I know somebody who wants to buy. I don't want to be their agent, but I want to call another agent and get part of their commission for referring business. That is allowed, but only because there is an exception to the law. Really and truly, that should be illegal. Real estate agents may neither pay nor accept any referral fee from a settlement service provider, such as an appraiser, a home inspector, an attorney. That would include real estate agents if we didn't have that exception. We do not take monies for the referrals of any type of anything that has to do with the settlement, unless you're a real estate agent. That is the only window. And remember, that can't go to you. It's got to go to your broker. Let's not go to real estate jail. Now, remember, I said unified settlement statements used to be the HUD one. Now it is the closing disclosure. So who has to be careful about RESPA? We do as real estate agents, because what we do relates to a real estate settlement. Attorneys, bankers, any type of loan that has to do with 1 to 4 unit residential properties, if it's going to have a refinance, an equity, home equity line of credit. But this does not apply to land. This does not apply to a purchase money mortgage or a cash transaction. There are some transactions that don't have to watch out for RESPA, but the majority of us in residential real estate, we're going to be dealing with RESPA because most people do get federally related mortgages. So just make sure you know the basics. Young kids eat up boogers, glue, and dirt. Now, I started with TILA. Then I moved to RESPA, and imagine those two laws, those two acts got together and had a baby. That is TRID, the TILA-RESPA Integrated Disclosure. You heard me say, as I explained those laws, RESPA requires you to have a good faith estimate. Truth in lending requires you to say, hey, this is the APR within 3 business days. They're basically the same numbers. So TRID came in and said, why do we have 14 pages when we could just use 6? And it covers the requirements of both acts. We got 7 for RESPA. We got 7 for truth in lending. Or let's make one document that's 6 pages. We're good. Now, again, I'm being silly with the number of pages, but that's what our loan estimate is. TRID says, let's use one document that covers the needs of 2 different acts. The loan estimate. 3 days. 3 days after applying for the loan, that borrower needs to get the loan estimate. Related, when it comes to settlement, RESPA said there needed to be a uniform disclosure statement. I think I said unified earlier, and I should have said uniform, but it needs to be a uniform disclosure statement. Then you've got truth in lending that says, hey, for the final numbers, you need to tell the borrower what this is going to be. So that's going to be our final TIL, or final truth in lending statement. They're both documents. They both have numbers. Again, instead of 14 pages, let's make it 6. And for closing, let's call it the CD, the closing disclosure. So remember, when it comes to the loan estimate, you got 3 business days, Monday through Saturday, for the bank to get the borrower the LE. When we're talking about closing or settlement, at least 3 business days before settlement, that borrower needs to get a copy of their CD, their settlement statement. Now, I want you to go ahead, take a screenshot. If you are really interested in the details of the difference between truth in lending, RESPA, and TRID, I've included this chart for you. But if I had to sum it up very quickly, I would say truth in lending is for a lot of lenders, not just for real estate. And it's about banks being honest to borrowers. And it has to do with the APR and being honest about how much is somebody actually going to pay. RESPA, the Real Estate Settlements Procedure Act, is about how can we make sure that these settlement statements, how do we make sure that just anything having to do with a real estate settlement is going, we're all kind of doing it the same way and it's fair. That's RESPA. And that's the big one where you cannot give kickbacks. TRID happened after TILA and RESPA. We married the two laws together and said, look, we're going to make less paperwork. For the 3 days after closing, both laws will use the loan estimate or the LE, and at least 3 days before, did I say 3 days before closing? At least 3 days after applying for the loan, you need to get the loan estimate, and at least 3 days before closing, you need to get the CD. And guys, the CFPB, if it was up and running, but the CFPB has the power that if a bank doesn't do these things, give you the loan estimate within 3 business days of application, give you the CD within 3 business days before closing, they could charge banks lots of fines. So this is a real thing. You want to make sure beyond the test that your borrowers, if you're working with buyers, that they are really getting a loan estimate and they're getting that CD, and that the numbers are similar to what they were told from the beginning. Now, when I say the CFPB could fine them, I wasn't playing. Look at some of these penalties. If they mess up and it's a first tier violation, TRID says that's $5,000 a day. RESPA could have a fine up to $10,000 per violation, and you could end up in jail for either TILA or RESPA. So you want to make sure that you're following these laws. Granted, a lot of it will have to do more so with banks, but you are part of this process and you need to understand this. All right, away from lending, let's talk about fair housing. And we know there's a whole bunch of laws, federal laws out there having to do with fair housing. Now, let me just remind you, this is a federal law review. There is a good chance your state has more state-specific laws that might give you more protected classes or tell you, hey, this is how we do it in this state. Cool. You should know that for your exam as well. What I'm going over is the Federal Fair Housing Acts. When you put these laws together, the Federal Fair Housing Act of 1968, the Housing and Community Development Act of 1974, the Federal Fair Housing Amendments of 1988, or the Fair Housing Acts, it means that we've got 7 protected classes federally. I like to teach that as Fred's corn. You're just going to get rid of the vowels in Fred's corn, the E and the O. So you're going to have familial status, race, disability, sex, color, religion, national origin. Let's make sure you know what each of those means. Familial status is not about whether you're married or single. It's about whether there are or are not little people, children, under the age of 18. Whether somebody has or could have or may have part-time children, maybe there's a separation or divorce, whatever. You might think about adopting. Whether or not there's children cannot be talked about, discussed, part of the discussion on whether somebody can or can't with housing. Just like we don't talk about Bruno, we don't talk about whether there are or are not children. That's what we mean by familial status. The first R in this is for race. And I'm pretty sure everybody knows what race is. Just remember, race is a protected class. So please never discriminate. Never make race have anything to do with your real estate transaction. The D is for disability. And when I say disability, I mean those with a disability, whether they are a mental or physical disability, you cannot discriminate or make any type of choices based off of that disability. This S is for sex, which most of the time is going to cover sex, gender, and sexual orientation. Now, the gender and sexual orientation is based off of court cases and things like that. But the actual law says sex. Go ahead, save yourself a humiliating lawsuit. And just assume when we say sex, that's a protected class along with gender, and sexual orientation. The C is for color, where we're talking about the color of somebody's skin. Again, this is another Bruno topic. We don't talk about, discuss, or make decisions based off of the color of somebody's skin. Religion, the R, is a protected class. There are lots of different religions, and some people who choose not to be a part of religion. That has nothing to do with real estate. People can live and be anywhere regardless of their religion. We don't make decisions based on it. We don't talk about it. We don't tell people, oh, this is particular religion and people of that religion are over here. Absolutely not. And then you've got national origin or nationality. Right? You don't get to make decisions based off of somebody's nationality, where they come from, the languages they speak. Absolutely not. Don't do that. Again, we don't want to be in federal prison orange. Now, our national law, Fair Housing Act does come with some exemptions. So what are our federal exemptions? If it is a for sale by owner, they don't own more than 3 single-family dwellings. And they don't do this more than once every 2 years. And as long as they are not involving a real estate agent in any way, shape, or form, they can choose to who they want to sell a house to. And it could be based on one of those protected classes, except race, and they would be fine. So the example I give is maybe I'm of ABC religion. I'm a for sale by owner, and I would really like to sell my home to somebody else of the same religion. I've gone in, I've made changes, I've made it so that you can practice our religion easier in our home. And as a for sale by owner, I didn't involve an agent. I didn't advertise anything saying, oh, I prefer ABC, religion only, as long as I don't do any of that. I don't own more than 3 single-family dwellings at one time, and I don't do this more than once every 2 years, then yes, I can choose who I want to sell the house to. But remember, it is never okay, even with this exemption, to discriminate based on race. Our second exemption, if I'm an owner-occupant of an apartment building with less than 5 units, so if it's 1 to 4 units, if I live in one of the units, I, as an owner-occupant, can choose who I want to be in the other units, whether it's religion, a disability, or somebody with kids. Do what you want, never race. But if I'm an owner-occupant of an apartment building with 1 to 4 units, yes, I am exempt from these FHA laws. Religious organizations and private clubs. As long as the club or the religious organization is not basing membership on one of the protected classes, they can say, hey, we only want our religion in this housing. Hey, we only want club members in our housing. That is fine. But again, you cannot have membership based on a protected criteria. And if you're a private club, this can't be something like a hotel or a motel. This would only be lodging or spaces for members, for the benefit of a member. It can't be for making money. And our last exemption, I know that the law says elderly, but please don't call people over the age of 55 or 60 or so. Look, do not call them elderly. But yes, there are laws when you see the active adult communities or 55, and over communities. The reason they can say that, because you then would be kind of eliminating children, is because there is an exemption in the Fair Housing Acts for these adult communities, for the elderly. Again, be careful with the word elderly, because some of these elderly, they'll get you. Okay. So you kept hearing me say when I was talking about the Fair Housing Acts that it was never okay to discriminate based on race. And that's because of the Civil Rights Act of 1866. Because of this act, which has no exemptions, there is no federal law that can say, oh, it's okay for you to discriminate based on race. There are never exemptions to this. But what it says is all citizens have the same right to inherit, buy, sell, or lease all real and personal property. It prohibits all racial discrimination, and this includes ethnicity. You cannot discriminate based off of somebody's ethnicity. Now, if you don't know the difference between race and ethnicity, let me make this very clear. First of all, you don't want to discriminate based on either. Think of race as the features you were born with, your DNA, and your ethnicity is how you were raised, your traditions, how you live your life, if that makes sense. So let's say you are one race, but you were adopted by another race and raised in with their ethnic traditions. Ethnicity and race generally are the same, but a lot of times they're not as well. You cannot discriminate based off ethnicity or race, ever. And if you feel like somebody has discriminated based on race, you can sue them personally in a private lawsuit, or this could end up in federal court and the government can go after that person. We do not discriminate based on race ever. Period. Okay. We've talked about fair housing, and everything that I talked about with FHA, that's housing. I just saw with the Civil Rights Act of 1866, it doesn't matter what it is, you cannot discriminate based on race. Then you have the ADA, Americans with Disabilities Act. This act covers and protects those Americans with disabilities. But it also relates directly to real estate. Yes, there's 5 different sections in the act, but when it comes to complying with the ADA, if you are an agent, remember, you cannot deny somebody with a disability, whether it's mental or physical, you can't deny them the ability to live someplace where they want to live. You can't decide, oh, this person's in a wheelchair, so I didn't show them or I didn't offer them this unit. Absolutely not. You don't get to decide what works well for somebody else. Also, if you're the landlord and somebody who has a disability would like to come in, rent the unit, but there need to be some modifications to make it work for them, you must allow them to do reasonable modifications, maybe lowering some countertops, widening doors, put, hardware in the showers or bathrooms, things that people may need so that they can live their life well. You must allow them to make those modifications at their expense. And when they leave, you may ask them to undo the modifications at their expense. Now, if you are somebody in property management, I need you to talk to an attorney and have a policy about fair housing in general, but also what is considered a reasonable modification and, what's going on. Just protect yourself. But realize the ADA, a federal law, says you don't get to decide who gets to live where. And if it's a reasonable modification, they can make those modifications at their expense, but also you can ask them to take it back to where it was at their expense. I could have included our next law, ECOA, or the Equal Credit Opportunity Act, with our other lending laws. But when I think of the ECOA, I think of fair housing because it's similar. A lot of the same protected classes we had with fair housing are also protected from discrimination in the granting of credit. It's a similar list. It is not the same. You'll see some race, color, religion, national origin, sex. We've seen that in our Fred's Corn. Race, color, religion, national origin, sex. You cannot discriminate on giving and give somebody or not give somebody credit because of any of those things. But then we've added some other ones. Marital status, whether or not somebody is married. I mean, I want to say 50 years ago, 60 years ago, which isn't that long ago, women couldn't get loans if they weren't married. Crazy and stupid, I know, but that's what it is. Age. You cannot look at somebody who's 80 and go, yeah, we don't want to give you a loan because we don't know how long you're going to live. Absolutely not. So somebody cannot be denied a loan because of their, based on just their age. Now, if you're under 18, you're still a minor. That's different. But you can't look at somebody who's considered elderly. Again, I hate that word. And say no loan for you. And then our last one is dependence on public assistance. A lot of people look at that and say, oh, well, if maybe they're Section 8 or something. First of all, there's nothing wrong with being Section 8. Second of all, there is all sorts of public assistance that people need and have to live their lives. So going back to what we were talking about earlier, maybe I have a disability and I'm getting money from the government to help me cover some of the costs, medical things like that. Look, you as the person who's giving the loan can't say, oh, some of your income comes from the government. No, absolutely not. You cannot do that. So the ECOA, or the Equal Credit Opportunity Act, is about prohibiting discrimination. This time it has to do with lending. Race, color, religion, national origin, sex, marital status, age, and dependence on public assistance. Again, it's similar to our fair housing laws, but not the exact same list. Equal Credit Opportunity Act, you see it there. You cannot require somebody to have their spouse sign a loan application. And a lot of people don't realize that you cannot say, oh, the money you're getting is coming from alimony or child support. That's none of your business. If they can prove the income is verifiable, so they know that this is the money that's coming in, here's where it's coming from. Not I'm selling drugs on the street, but if you have verifiable income, even if it is from alimony or such things, they need to include it. And you can't ask if somebody's going to have kids, anything like that. Now, I know I don't really have this here as a slide, but guys, don't forget, similar to discrimination and lending, you have redlining. Redlining is when a bank says, oh, we don't make loans in a certain area because of the racial makeup or the religion or something like that. Redlining has to do with lenders not discriminating, which is different than blockbusting or panic peddling, which is where you try to get sellers to move because a certain protected class is moving in. Or steering, which is where you take people, if you're a buyer's agent, only to certain neighborhoods based on their religion or race or disability or something like that. So redlining, panic peddling or blockbusting, and steering, you need to know those words too when it comes to fair housing. Well, our next one is Statute of Frauds. And yes, I just realized I spelled statute wrong. Please forgive me. I'll fix that in the video recording. But the Statute of Frauds, it says that some contracts have to be in writing. I know at some point in your class that you learned that in order for us to have a valid contract, you had to have mutual agreement or meetings of the minds, consideration, legal capacity, lawful objective. I know that. But the law, specifically the Statute of Frauds, says some contracts have to be in writing in order to be enforceable. Specifically for us, for this test, any contract to sell or convey any interest in real property. I mean, that's just what it is. Now, I do see that my slide says leases exceeding 3 years in duration. I apologize. In some states, in many places, that's going to be 1 year in duration. So I just should have said leases exceeding some years in duration. Some places it's 3, some places it's 1. Heck, I don't know every state. It could be 4. For your test, you figure out what it is in your state. Leases exceeding a certain amount of years has to be in writing. But you really, 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 really need to know on a federal level, contracts to sell or convey any interest in real property have to be in writing. Not all contracts have to be in writing, just certain contracts have to be in writing, specifically if you're selling or conveying real property. Moving on, we've got the Residential Lead-Based Paint Hazard Reduction Act. It is always a mouthful. But I know you remember the magic year, 1978. This act says if somebody is either going to be buying or leasing or renting a home built before 1978, we call that target housing. If somebody is leasing or buying a house or a condo or an apartment or a townhome, whatever the housing is that was built before 1978, then we have to make sure the disclosure is given, telling them, hey, there could be a lead-based paint hazard in this home. Sales and rentals. And they must be given this booklet written by the EPA called Protect Your Family from Lead in Your Home. Now, you don't have to do this. You want to sell houses, you want to rent homes to people, cool, don't do it. But do you see this? Fines for violations up to $750 per day and up to $32,500 per day under some of the EPA sanctions. Go ahead and mess around with this if you want to. Just remember the magic number. The house was built before 1978. They need to be given some information about lead-based paint. Even if the house was revamped, rebuilt, it was updated, I don't care. You need to look at the laws. Because usually, I don't care if you totally gutted it and started over. Unless the house was certified lead-based paint free, you're going to have to give them the disclosure. And even if it was certified lead-based paint free, you need to provide the certification. So just remember, if it was built 78 and after, no disclosure needed. 77 and before, so if it was built before 1978, then you need to disclose. Disclose, disclose, disclose. It goes along with location, location, location. We've got our Sherman Antitrust Act, which I do believe is going to be our last one, maybe? This might be our last one. Sherman Antitrust Act. Some of you all have heard about how the Realtor Association went through a lawsuit. And that's because antitrust violations, that's what we were accused of. I am neither admitting nor denying whether we did or did not do these things. That is above my pay grade. But you need to be aware of the Sherman Antitrust Act. The whole idea behind antitrust laws is that you cannot do anything that's going to promote anti-competitive behavior. No monopolies. Right? You can't use unfair business practices that reduce competition. So you can't do price fixing. As real estate agents, if you are ever in a room where people start discussing as a group, this is what we should charge for commissions or compensation, get out. Now, if it is just your office, cool. Your office, do what you want to do. But if it's multiple offices, brokers, whatever, agents talking about this is what we should charge, leave before you get caught up in a raid. It is highly illegal to price fix. Don't do that. And I know you know this because I know if you left the house today and every gas station in America said all gas is going to be nothing less than $7 a gallon. They got together and just willy-nilly decided it. You'd be like, wait, I don't think you can do that. You're absolutely right. You can't do that. That is price fixing. You can't group boycott. You can't say, hey, we don't like brand B. We're just not going to show any of their houses. You can't decide, oh, well, we only let brand B do houses on the north side of town and brand A do houses on the south side of town. And we just promise to send people where they're supposed to be as an industry. Absolutely not. And you can't have tie-in agreements, which is you can't say, if you use me, you must use this escrow agent, this attorney, this home inspector, this, that. You can't do that. That's a tie-in agreement, and that is also illegal. When it comes to these antitrust laws, since we, are still dealing with the fallout from the lawsuit, you need to be very careful. As a broker or an agent, you should never use a phrase like, oh, the standard or normal commission is this. Here's what you're probably going to pay. This is the going rate of what people charge. Absolutely not. You never make it sound like there is a normal compensation rate or amount. Instead, you can say things, this is what I charge, this is what my company charges, this is what my firm charges, here's what I'm asking for, here, something like that. But we never make the public think, oh, there's a minimum. The public can pay in compensation whatever they negotiate. It is always a negotiation between you and the person you're providing the service to. So that's it. I know that was probably longer than you wanted, but hopefully it was very helpful to you. If you have more questions, because that was really quick. If you have more questions about any of these laws, please let me know. You can ask during one of the live sessions. And remember, these were the highlights. I want to make sure you understand there's more information that could possibly be on your test I didn't go over. But if this was a good review, yay. And again, guys, thanks for letting me be absent this past week. I hope this helped, and I will see you very soon. Bye, everybody.